Have you ever repeated this phrase to yourself when your portfolio turned red? Just hodl, the market always goes up in the long run. It wraps around you like a worn-out blanket when every candle on your chart is bleeding. When your total balance drops 20% in a single month and you can't bring yourself to open your investment app. It sounds like wisdom, doesn't it? The gurus say it keeps you from panic selling at the absolute bottom. They say discipline equals long-term gains. But what if that comforting phrase is the very thing that will wipe out half your life savings? What if all that patient holding you've been told to practice is just slow rot, eating away at your capital until there's nothing left? Let's stop repeating slogans we heard on social media. Let's stop trusting the gurus who make money selling you that narrative, no matter what happens to your money. Let's pull back the curtain and look at what actually happens to investors who blindly hodl through every crash. Does the market always go up in the long run? Or is that just a lie that gets repeated until everyone believes it, even when the data says the opposite? The data doesn't lie, and it comes straight from an independent source you can trust. The U.S. Securities and Exchange Commission, 2026 update. Let me read that number again, slow, so it sinks in. Over 40% of all individual stocks that suffer a 40% or greater crash never return to their previous all-time highs. Not in 5 years. Not in 10 years. Not ever. That means almost half the time, if you just hold on and wait for the recovery the gurus promise, you'll wait forever. That's not the worst part. Nearly 15% of those companies never even stabilize. They either get delisted from major exchanges entirely, or they slowly bleed value quarter after quarter until their share price hits zero. All that long-term discipline you forced yourself to practice, all those years of skipping dinners, cutting back on vacations, socking away every extra dollar for your future, it just turns your life savings into worthless wallpaper you can't sell for enough to cover a cup of coffee. If you're blindly holding every falling stock in your portfolio, and you don't have a clear plan to stop the bleeding before it kills your capital, you aren't investing. You're gambling with the money you set aside for your kids' college tuition. You're gambling with your retirement fund. You're gambling with the down payment you've saved for your first house. The odds aren't in your favor. The math isn't on your side. And the gurus who sold you the HODL myth won't refund your losses when it all goes wrong. This is where the gurus pull their oldest, dirtiest trick. The survival bias lie. When they tell you to buy and hold forever, what do they show you? They pull up the 3-0-year chart of the S&P 500. They point to giants that have grown year after year, decade after decade. They tell you if you just held on through every crash and every correction, you'd be sitting on a fortune just like the people who bought into those companies early. They show you the straight-up line, and they tell you discipline pays off. But they leave out one tiny, critical detail that changes everything. For every one company that survived and thrived, there are dozens that didn't. They don't show you those charts. They don't talk about those companies. Let me name a few that you all remember. There's Nokia, the mobile phone giant that dominated the entire 1990s. When the iPhone launched, it wiped out Nokia's core market, and the company never recovered. Then there's BlackBerry, the gold standard for business mobile phones for more than a decade. Every executive carried one. Today, it trades for less than $5 a share. It never came back. And let's not forget the hundreds of AI darlings from the 2024 hype cycle. Most of them have already vanished from the major exchanges. The gurus never show you those names. They only show you the winners, because that's how they sell their narrative. Now pull back and look at the full picture right now, in 2026. Compare our current landscape to the dot-com bubble of 2000, and the similarities aren't just striking, they're terrifying. Back in 2000, everyone was hyped about a new, transformative technology that was going to change the world. Retail investors flooded into the sector. Valuations blew past every reasonable metric. Companies with no revenue, no clear path to profit, were valued at billions of dollars before they even sold a single product. People bought the hype, held on blind, and waited for the long run to pay off. What happened? 75% of all dot-com companies crashed and never came back. Millions of ordinary investors lost everything they'd put in. The recovery never came for most of them. Fast forward to today. We have the exact same hype around artificial intelligence. We have the exact same insane overvaluation across the entire sector. We have the exact same flood of retail money pouring into unprofitable companies with no clear path to sustained earnings. Most of these companies will follow the exact same path as those 2000 dot-com darlings. They will crash. They will never recover. Blindly holding an individual stock through a structural shift in the global economy isn't smart discipline. It's active negligence with your own hard-earned money. You can't afford to wait this one out. You can't afford to cross your fingers and hope for the best. The numbers don't lie. The precedents are clear. The storm is already on the horizon, and most investors have nothing to shield them from it. This brings us to the first of the 5 wealth survival mechanisms, the dynamic stop-loss. We draw a non-negotiable line in the sand at 20%. If your stock drops 20% below its 200-day moving average, you sell. No questions, no waiting, no hope that it will bounce back. Let's back this up with hard data, not guru hype. Over 50 years of consistent U.S. stock market data. Here's what we see. Once a high-quality, fundamentally sound stock drops more than 20% below its long-term moving average, it has entered what we call a broken trend phase. The odds of it ever recovering to its previous all-time highs drop below 20%. That means 4 times out of 5, the recovery you're waiting for will never come. You're just waiting for a miracle that will never arrive. Professional traders don't sit around and cross their fingers. They don't hold on and pray for a bounce. They exit. By exiting at the 20% stop loss, they preserve 80% of their capital to fight another day. 80% of your capital is still in your pocket, ready to deploy into a better, stronger trade with working momentum. That's a far better position than riding a broken stock all the way to zero, where you lose 100% of your money. Hope is not a strategy. If the ship is sinking, you don't stay in your cabin hoping the water level will recede on its own. You get on the lifeboat. You patch the hole in your portfolio. You live to sail another day. That's the entire point of the dynamic stop-loss. It cuts your losses early, before they turn into permanent, irreversible destruction of your wealth. Now we move to mechanism number 2, asset correlation isolation. This is one of the most misunderstood rules of wealth protection. Most of you think you're already diversified because you own 10 different stocks instead of just one. I hear this mistake every single day from new investors. But if all 10 of those stocks are in the tech or AI sector, you aren't diversified. You're just 10 times more vulnerable to a single sector-wide crash. We watched this play out in real time in the first quarter of 2026. When the AI correction hit, every single AI stock crashed. It didn't matter which company had solid earnings and which was just hype. The contagion spread across the entire sector in 72 hours. Even the best, strongest AI companies dropped 30% right alongside the worst garbage. If you were all in on AI, no matter how many different names you held, you had no place to hide. You must ensure your assets aren't all highly correlated with each other. When the tech sector tanks, do you hold defensive assets that move in the opposite direction? Consumer staples, hard commodities like gold and oil, government bonds, these assets often hold their value or even rise when growth sectors crash. We move now to mechanism number 4, the disciplined art of rebalancing. This rule fixes the single most common mistake that greedy retail investors make over and over again. Most people can't bring themselves to take profits when they have them. When a stock or sector doubles in 12 months, they start telling themselves it will triple, then quadruple. They hold all the way up through the rally, then hold all the way back down through the crash, and end up with nothing but the same of capital they started with, or worse. In the 2026 market, Constant mean reversion is the rule. Any asset that goes up too far, too fast, will always crash back to its average value. If one single asset becomes 30% or more of your entire portfolio, you are drastically overexposed. One sudden correction can wipe out half of your total accumulated wealth. Rebalancing fixes this with a simple, mechanical rule. You set a fixed target percentage for every asset class in your portfolio. Let's say you target 20% of your portfolio for AI stocks. When the AI rally runs hot, and that allocation jumps to 35%, you sell 15% of your AI position and move that capital into undervalued sectors that are under your target. It automatically forces you to sell high and buy low, without letting greed or fear cloud your judgment. It locks in gains and cuts your risk before the market overheats and crashes. Now that we've covered all 5 core defense mechanisms, let's get practical. How do you actually know if your long-term stock is still worth holding after a big drop? In 2026, stop staring at the daily stock price ticker and scrolling through message boards for validation. Start looking directly at the company's free cash flow. Price moves up and down for all kinds of irrational reasons: news, rumors, algorithmic flash crashes, sector contagion that has nothing to do with your specific company. A falling stock price is just a warning sign to dig deeper. But if a company's core fundamentals, the actual cold hard cash it generates after paying all its expenses, decline for 2 consecutive quarters, your loyalty to that stock is nothing but the sunk cost fallacy in action. You aren't holding because the stock is still a good investment. You're holding because you don't want to admit you made a mistake. That's a choice that costs thousands, even hundreds of thousands of dollars in lost wealth. When the fundamentals break, you sell it and move on to better opportunities. No shame, no regret. In the end, remember this simple, unvarnished truth. The market doesn't care about your loyalty to a company. It doesn't care how long you've held a position, or how much you want it to go back up. It only cares about current value. Being a successful master investor isn't about how much you can make in a red-hot bull market. Every amateur can make money when the whole market is going up. It's about how much you keep when the bear market comes. Protecting your original principal is 100 times more important than chasing the next 10x gain that may never come. If you don't want to be one of the 40% who end up stuck with a dead stock that never recovers, or one of the 15% who lose every cent when a company delists, it's time to stop waiting for miracles. It's time to audit your portfolio today. Pull it up right now, if you're watching this on your phone while you wait for coffee, or at your desk during your lunch break. Ask yourself one hard, clear question. Am I actually a strategic investor with a defense plan to protect my capital, or am I just a blind hodler waiting for a miracle that will never come? If you can't answer yes to having a solid defense plan in place, or you're not sure your current setup can hold up to the next big correction, I've got something to help you move forward right now. If you're not sure how to set your dynamic stop-loss levels correctly, or you don't know how to build the right black swan hedge for your specific positions, just comment defense below this video. I'll send you my updated 2026 risk management calculator completely free. This tool walks you step by step through setting up every single one of the 5 capital defense mechanisms we covered today, tailored to your own portfolio size and your own risk tolerance. You don't need any fancy software or advanced accounting experience to use it. Stop drinking the buy and hold forever Kool-Aid that the gurus sell to keep you holding their bags. Stop letting your life savings, the money you save for retirement, your kids' college, your first home sit exposed to the next big crash. Start building a fortress around your wealth today. If this video cut through the hype and gave you clear, actionable steps to protect what you've built, hit the subscribe button right now. Ring that notification bell so you don't miss the next strategy update that can keep you one step ahead of the 2026 bear market. We're in this brutal zero-sum game together. Let's make it out on the other side with our wealth intact. I'll see you in the next one.